Imagine this. You spent years building a digital fortune, carefully picking every investment, watching it grow, only for it to become a massive, expensive headache for your family when you're gone. It's a huge issue for anyone holding crypto in the UK, and today we're going to break down exactly what you need to know. This discussion has been put together by the experts over at My Tax Accountant.
So let me ask you this. What actually happens to your crypto if you're not around to unlock it? It's a pretty scary thought, isn't it? The reality is, HMRC could get its hands on a huge slice of it before your family ever sees a single penny. This is the hidden trap that so many people are falling into.
And look, because these traps are so tricky and the stakes are just so high, we've worked directly with the tax experts at My Tax Accountant. Honestly, they see these problems day in, day out, they know exactly how to handle them, which means the information you're getting today is spot on, up to date, and absolutely vital for 2026 and beyond.
Right, so let's dive in by looking at a situation that's becoming all too common. We're calling this section a digital fortune at risk. Let's talk about Alex. Alex runs a small business in London. And for the last few years, on top of running the company, Alex been getting into cryptocurrencies, building up a pretty significant portfolio. I bet that story sounds familiar to a lot of you.
That portfolio, it's now worth a whopping £500,000. I mean, that's life-changing money, right? It's meant to secure the future for Alex's family. But, and it's a big but, without the right plan, it's just sitting on a tax cliff edge.
And that cliff edge is called inheritance tax, or IHT. To put it simply, it's a tax on the total value of everything you own when you pass away. And by everything, I mean your property, your money, your possessions, and you guessed it, your digital assets too.
And let's be crystal clear on this. HMRC doesn't see crypto as some sort of vague, untaxable internet money. No way. They officially classify digital tokens as property, putting them in the exact same box as shares and savings. The bottom line is, they absolutely count towards your estate's valuation.
So how does this tax actually work? Well, everyone gets a tax-free allowance, which is called the nil rate band. For the 2025-26 tax year, that's £325,000. Anything your estate is worth below that amount gets passed on tax-free, but anything above it gets hit with a massive 40% tax.
And this is where you can really see Alex's problem. The crypto portfolio alone, at £500,000, is already way over that tax-free limit. And that's before we even add in other things like a house or savings. This digital fortune has, without Alex even realizing it, created a huge tax bill waiting to happen.
But that's not all. There's a major change coming that makes this whole thing even more urgent. Let's take a look at what we're calling the 2026 tax revolution.
And please, you're going to want to stay with me for this. This next bit about the new reporting rules is something every single person holding crypto in the UK needs to hear. It's a total game changer.
Okay, so from the 1st of January 2026, something called the Crypto Asset Reporting Framework, or CARF, kicks in. This basically means that crypto exchanges will start collecting detailed data on all their UK users. Then, by the 31st of May 2027, they have to send their first full reports straight to HMRC. This isn't just a suggestion, it's happening. The difference this makes is just massive. Up until now, HMRC has pretty much relied on people telling them about their crypto. But from 2026, they're getting a direct data feed from the exchanges. This gives them complete transparency. They can see your activity, your balances, your transactions. There's literally nowhere to hide.
So what does this actually mean for Alex, our small business owner? It means the whole idea of having some crypto off the books is finished. It's over. HMRC will know those assets exist, and the person dealing with the estate will have zero choice but to declare them.
Right, so let's assume the assets are all declared properly. That brings us to the next massive problem, which is a bit of a practical and technical nightmare for a lot of people. Welcome to the crypto valuation nightmare.
The rule itself sounds simple, doesn't it? For IHT, your crypto is valued at whatever its market value was on the day you died. It's like a single snapshot in time. But what's so important to get is that if the market crashes the very next day, it doesn't matter. The tax is calculated on that one, potentially sky-high valuation.
And here's where it gets really messy. Which market value do you even use? At the very same moment in time, the price of Bitcoin can be different on different exchanges. It might not seem like a big deal. But when you're talking about a large portfolio, those tiny differences can add up to thousands of pounds in extra tax.
Now, Alex thought getting the valuation right was the biggest challenge. But that's not even close. Here's where the real, most devastating trap is hidden.
But before we get to that, here's a quick pro tip on valuation. The best way to handle this is, first, take a snapshot of the price on several big exchanges at the exact same time. Second, work out a fair, defensible average. And third, you have to document absolutely everything. Screenshots, links, your calculations, to prove how you got your number to HMRC.
Okay, so let's move on to the single biggest risk of all. This is the one that can wipe out an entire digital inheritance in a blink of an eye. We call this the lost keys trap.
This quote from currency expert Andreas Georgiou just says it all, really. For anyone who's new to this, think of a private key as the master password for a bank account. But unlike a bank, there's no customer service to call to reset it. If that key is lost, the crypto is locked away forever. It's gone.
So for Alex, this is the ultimate nightmare scenario. Without a clear, secure plan for passing on access, that £500,000 digital fortune becomes a £0 inheritance. The family knows it's there, and worse, HMRC will still expect tax to be paid on its value, but nobody can actually get to the money.
It's a terrifying thought, but the good news is it's completely preventable. So let's switch gears from the problems to the solutions. Here are the smart steps you can take to protect your assets.
You see, a standard will just often isn't good enough for this. A much better option is a digital asset trust. This is a legal setup designed specifically for things like crypto. And its biggest advantage? It can completely bypass probate. That means the assets don't have to go through that long, public, and expensive court process. It keeps things private and makes sure your chosen trustees have clear, secure instructions to access everything when they need. And hey, did you know there are several perfectly legal ways to shrink your estate's potential tax bill? For instance, any gifts you make to your spouse or civil partner are completely exempt from inheritance tax. You also have an annual gift allowance of £3,000 you can give away each tax year. Oh, and any gifts to registered charities are also totally exempt.
Just a quick word of warning though, these are not simple do-it-yourself fixes. They need really careful professional planning. The timing of gifts and how you structure these trusts are absolutely critical to make sure they work and that you stay on the right side of HMRC rules.
Which brings us to our final section, where we're going to pull everything we've talked about together into a clear plan of action. This is your digital legacy plan.
Probably the most practical thing you can do right now is create what's called a digital legacy pack. Step 1, make a detailed list of all your assets, every exchange, every single wallet. Step 2, write down how you want them to be valued. Step 3, and this is the most important one, set up a secure way for your executor to get access. And finally, Step 4, make sure this pack is properly and legally linked to your formal will or trust.
So what happened with Alex? Well, by taking these exact steps, Alex managed to turn that feeling of pure panic into a clear, secure, and tax-efficient plan. Alex's family now has a proper roadmap to follow, which means their digital legacy is completely protected. So to quickly recap, here's your action plan. Inventory your assets and document your access info right now. Value what you hold at least once a year so you know what tax you might be looking at. And most importantly, get professional advice immediately to help you get through these complicated rules and protect your legacy.
So that leaves us with one last, really important question for you to think about. Are your digital assets a protected legacy for your family's future, or are they, right now, just a ticking tax bomb waiting to go off?
And as we finish up, it's really important for me to say that the information we've shared here is for general guidance. It's here to make you aware of the issues, but because everyone's situation is different, you shouldn't rely on it alone to make your financial decisions.
Before you make any decisions at all about your estate or your digital assets, you really must speak with qualified professionals who can give you advice that's tailored specifically to you. The experts at My Tax Accountant are ready to give you that tailored advice. For professional help, you can call them on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. And for more great insights like this, make sure you subscribe to their YouTube channel. Thanks so much for watching.